The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you and, if in doubt, speak to a licensed financial advisor.
Hey guys, and welcome to a new episode of Aussie Fire. So this show is actually going to be our first ever listener questions episode. And so in this episode, we're going to just sit down and answer a bunch of different questions that were sent in by you guys. And by the way, if you have some questions that you'd like us to answer on a future episode, you can send them to us at hello@aussiefirepod.com, or you can also send us a quick text using the link in the show notes. So we had a few of these questions building up, and I thought it was time that we would actually put a bundle of them together and then answer them on an episode. So we're going to do that today. So Hayden, you excited, mate? This is our first ever Q&A.
Yeah, I honestly, I really am. It's just my favorite thing, really. Like, you and I talking together into the ether is pretty fun, Dave. I'm not going to lie, but you know, knowing we have people listening to this and being able to engage with them, I think it makes this in some ways one of the most exciting episodes for me. And I think we'll just kind of jump straight into the first question, which I do really like because it's something that I've thought about before too. I'm sure many of our listeners have, which is the benefit of these questions. And the question is, when shares are up quite high like they are at the moment, what are the cons of selling them now and then buying them when or if they drop again? And the person has also said, obviously it would be risky if they don't drop, but what are other implications that may arise or things to consider? I'm sure, have you ever had that thought, Dave, about, wow, the market's high, maybe I should sell it now and, you know, just see what happens. Maybe it'll go down or probably go down. Maybe I'll just buy it when it goes down.
I haven't really, because before, I suppose at the time when I first got into shares, I was reading very, very heavily about long-term strategy and kind of what makes sense and what doesn't make sense as what to do with your portfolio and stuff like that. So quite early on, I realized that probably wasn't the best idea. And so that is going to be my answer here. It's a very common thing to wonder, and I totally understand why, because the future's uncertain. If we think that the share market is at a high point right now, then obviously we might naturally have the feeling like, oh, maybe I'll sell now for a decent price, lock in some profits, most likely. And then in the future, when the market falls, because we know it will fall at some point, then I will buy back in cheaper. And then I'll make even better gains when the market goes back up in the future. And so that sounds like a perfect strategy, but good luck implementing it. That's all I'll say. Like, it's just going to be so incredibly hard for a whole host of different reasons. And so before you even get into the idea of buying back in later, you're selling out first. Okay, so let's say you sell today for a decent price. The first issue you come across is you have to pay tax on your capital gain. And so we won't bother getting into the numbers, but as you can imagine, you have to pay some sort of taxes if you've made a profit today. If you haven't made a profit, I'm not sure why you would actually bother selling. So you lose some money today. So that straight away, that means you're behind where you were yesterday. So now you need the market to fall just to break even. So already you're kind of behind the eight ball. So that's not a great start straight away.
Yeah, absolutely. And I mean, I think this question, it's the same. It's a variation of the exact same question of other questions, which might be like, the market seems high. Should I wait till it falls to make my first buy? You know, because they are exactly the same question. And, you know, I could tell you from experience, like there are times when I've tried to do that. It has worked before. It has not worked before. You often end up just, at least, you know, from what I've seen and talking to a few friends, you can end up just really like tired and exhausted from it with, you know, maybe marginal gain or marginal loss. But I think the worst part is like I think it's always easier psychologically to deal with the results of inaction than action. You know, like if you don't sell and then it goes down, you chose not to sell, you didn't participate. So you kind of are like, oh, okay, you know, that's all right. But when you do sell and it goes up, you're like, man, I actually stepped out onto the road here and did something to hurt myself. I think feeling sad because of inaction, I think for most people is a little bit easier to stomach to some extent. I probably would say like there have been maybe a couple of times where it was immediately obvious to me. And when I say a couple, I only mean one. And I think that was at COVID. I didn't have any money at the time to invest, but when like the stock market went down 40% right after COVID happened, if I had money, I would have 100% been like, it's definitely going to figure its way back up. Now might be a good time to put a bit of extra money in. But in my 6 years of investing, I don't think there's ever been a time besides that initial COVID crash that I've ever been like feeling good about a timing decision. Which I think is indicative of how messy it all is.
You mentioned something really interesting there that I think most people don't actually consider when they're thinking about this, and that is the mental fatigue or the mental anguish, I'll say, that comes with these sorts of decisions. So because you have to make a decision to get out of the market, you're going to be watching it like an absolute hawk after that. And then that's one decision. And so you have a certain likelihood of getting that right or wrong. But then you also have to get back in the market later. So then, as you can imagine, you'll be watching it, perhaps like you were, Hayden, and maybe some of your friends that you've had this experience too. But then you have to make a decision on when to get back in. And then afterwards, you'll be comparing, was that the right time? Should I have waited longer? Should I have got back in earlier? And it's just so incredibly difficult. And the reason, sometimes people go into it with a plan. So they'll say, well, I think the market is high now based on X, Y, Z. So let me sell. And then when the market goes down a decent amount, like 10% or 20%, then I'll buy back in. And so this sounds a little bit more intelligent because they actually have a plan. The issue with that in practice is what happens if the market goes down 18% or 17%, but you plan to buy back in when it went down 20%? What are you going to do? Are you going to buy back in and break your rule? Or are you going to just sit there and wait for it to go down some more? But what if it doesn't actually go down more? Because more than a 20% drop is not very common. So then you're betting on a lower probability event. And what if your rule was, 30% or more? You're going to have to stretch out that time frame. And generally speaking, the longer you wait and the longer you're out of the market, the more likely you are to have missed out on gains, because from what the research shows us on the history of stock market returns, in most calendar years, the market simply goes up or pays dividends. So in 75 to 80%, I think it's 75 in the US and something like 80% in Australia or close to it, of years, the market has a positive return. So in all likelihood, if you sell and you're out of the market, that's a losing bet. Like you're probably not going to come out better off than if you had just stayed in the market in the first place. And that's ignoring things like capital gains tax that I mentioned earlier. And that's also ignoring the mental anguish that comes with making these sorts of decisions. So it's not to say it can never work. It's just to say that the odds are really, really against you. And it is way more stressful and way more anxiety inducing, I think, than most people imagine.
Yeah, there's other elements too, right? Like every time you make a sell or buy, it will finitely add some amount of time to your tax return, or it'll add some time to your accountant doing your tax return too. There's lots of little flow-on effects. I'd never want to say it's outright bad, but man, you have to be just so sure of what you're doing, I could think of a few theoretical scenarios, so I'd never say it's always bad, but if you're kind of umming and ahhing, or even, not speaking to this particular person, but if you're kind of asking people around, I'm not sure if I should do this, you probably shouldn't, would be my general comment, because you're probably not sure enough about, that particular decision, given that there's on average a higher chance of it going not your way than there is it going your way.
That's an interesting point. I don't know if you've noticed this, mate, but I've also seen, I suppose it's something that happens with people that maybe get into the weeds on this market valuation type stuff, and then they think, or maybe they read some doomsday stuff and they become 100% convinced that the world's about to end. There's going to be some sort of great collapse just around the corner. I find those people to be the most confident when they really shouldn't be, because they're making like the strongest bet against what usually happens year in and year out. So I find those people to be extremely have sort of this unfounded confidence in what they're doing and why. And so that's fine. I'm not saying that they need to adopt a certain approaches because I do. I'm just saying that I wouldn't necessarily have confidence up there as like a metric on whether your actions are the right actions or not.
That's fair. I have another way I think about it, Dave, which is going to be really weird, is that tangentially, sometimes if I'm out somewhere like an hour from my home, like in the north of Sydney, and I see like a dessert place, like an ice cream place, sometimes I actually don't want to buy it because I'm like, there's only really two outcomes here. The first one is I don't like it and waste my money. The other one is I really do like it, and then I'll just be in a constant point where I'm like, damn it, my favorite ice cream is really far from home. And if I go get it, I'm putting in all this effort to get to my favorite ice cream. And I'm kind of like, let's just enjoy life without having spent money on that ice cream. And it kind of reminds me is you can, because I've done this kind of stuff before, you do your little sell and your little buy. Okay, you lose money. Don't do that again. Not good. But let's say you make some money. What are you going to do then? Stop? You're going to be like, oh, cool. That was great. Good plan. Never again. Like if you're a normal person who's tempted by stuff, you're going to be like, oh, I'm good. Let's keep going. And then you're going to probably, shoot yourself in the foot at another point because it's hard to stop. It's that kind of casino mentality that people can get exposed to and then get sucked into. So I think there's also that other element. Like, sure, maybe it works for you that time, but do you really think you could stop after you did something and made money? I think most of the people I know in my life would keep going. If that makes sense.
That's an excellent point, man. I suppose what that's saying is that sometimes the worst thing that happens to you is you get something right the first time, but it wasn't actually due to skill and knowledge. It was just due to luck or happenstance. So that's definitely a concerning thing that might happen. So you might make that decision and then you think you're a genius, and then the next time you try it with a larger dollar amount involved and you become convinced in your abilities and you become overconfident in your ability to assess when to get back in, and then that doesn't work out and then you end up losing a whole lot more than you made in the first place. So that's definitely important to keep in mind.
And to our listeners trying to time the market, sometimes it just sucks. Like I bought my first share in like August of 2018. I didn't know what I was doing. It turns out I was in the middle of like a localized market high and I was in the red for like 14 months or something, and that happens to some of us. Some people bought shares at a time and they like went up 30% in the last 18 months, and good on them. I had a horrible time with it, but you just got to keep telling yourself, doesn't matter if I just keep holding them, they'll go green again, or they'll go green more than they do now. And
also because you're ideally investing every month, those prices have a natural, those purchase prices rather, have a natural kind of smoothing out of themselves because you're buying at all sorts of different levels. And then when the market does go down, sure, you didn't buy the previous purchase at the right amount because it's now market's down lower, but actually when you're investing now, your dollars are stretching further because the price is now lower. So you get this natural sort of smoothing mechanism and the benefit of dollar cost averaging. So, and each purchase you make kind of dilutes the importance of the previous purchase. So you don't, if you're a regular investor, even less you have to worry about what the particular price is over time because it gets smoothed out because of so many transactions over time.
Yeah, absolutely. Cool. Well, that was interesting. I always love a good timing the market conversation. It's always a lot of psychology to unpack, and I'm the same as most of our listeners. I'm always tempted by things now and again. The next question is, should I invest in individual shares since they have more franking credits than ETFs? So this person is speaking specifically in relation to ASX shares or ETFs because we're talking about franking credits. And it's a good question. It's like, so someone's clearly gone and looked at some individual shares and noticed that they have more franking credits, more tax benefits than some ETFs, which might not have the same degree of tax benefits. And I know, Dave, you've probably spent more time than me looking around with, Australian ETFs in particular. And I guess it's like, where would this strategy make sense, if ever, to you, is saying, I want more franking credits, so I'm going to buy CommBank and stuff directly. I don't know what CommBank's franking credits are as opposed to an ETF.
Yeah, it's an interesting question. I suppose firstly we need to kind of unpack why certain companies or certain shares have more franking credits than others, because that's essentially what's really going on behind the scenes here, and it's maybe not what you might think depending on your level of understanding. So it is true that some shares and their dividends will be 100% franked, while other shares and more commonly Australian ETFs will have dividends that are not 100% franked. More likely if it's an index fund, say like VAS or IOZ or A200 or something like that, the franking level is probably going to be something like 75 or 80% in most years. And so the reason for that is because there are companies inside the portfolio that don't pay fully franked dividends and they don't pass on franking credits. And so that's what ends up having an effect on the overall dividend that index fund is able to pay, because they're simply passing on whatever they receive during the year, the income and the franking credits. So there's a few reasons why companies themselves won't actually pass on franking credits and why that affects the underlying portfolio. And so sometimes that's because they are companies which earn money overseas, and so they may not actually earn a lot of money in Australia and pay enough tax in Australia to actually be able to pass on franking credits, because most of the earnings may come from overseas sources. So there's not actually any tax credits to pass on. And that's not necessarily a bad thing. It just means that the money's coming from elsewhere. There's not Australian tax that's been paid. Another way that might happen is with something like a real estate trust, where they're taxed a bit differently to a company, where a company earns money, pays tax, then it can pay a dividend and then pass on the tax credit, like a franking credit for the tax that they paid. So something like a real estate trust is taxed a bit differently, where for the most part, I believe the ruling is if they pay out the vast majority of their earnings, something like 90% or more, they don't pay tax. And so essentially you'll end up paying tax on those earnings. So the money is passed straight through to you, and although it doesn't come with a franking credit, it means there's been less tax on the same dollars before they reached you. So more franking is not necessarily better than less franking. It doesn't really work like that. Like franking credit is not just like magic money, right? It comes from tax that a company has paid. So aiming for the most franking credits, I would say, is not really... It kind of misses the point. I wouldn't be buying shares just because one's 100% franked and one is not. So another way you'll see this compared, especially in Australia and with index funds and other options, is with a listed investment company. So you can have a listed investment company, and if they invest in the top 300 companies, just like an index fund would, they'll have to pay tax on some of their earnings because they're a company, whereas an index fund operates as a trust. And so because they pay tax, they'll generate some franking credits. And so that's why you'll see listed investment companies or LICs and their dividends are pretty much always fully franked. It's because they pay tax, whereas index funds do not pay tax. They simply pass on whatever dividends and whatever franking credits they get. And so it's basically works out the same, and you're not actually getting more because there's been more tax paid in the first place before that other money got to you. So it might be a bit of a convoluted and tricky way of covering the question, but I hope that kind of explains the difference in tax mechanisms for different products and why they're a bit different and why it's not necessarily better to have more franking credits or whatever the case may be. So I wouldn't necessarily focus there. I would focus on just picking some sensible long-term investments that align with a strategy that you're happy to stick with for a long time, and not ideally not succumb to selling and then trying to buy back again at a lower price.
It's really interesting, Dave. I mean, I like how you kind of described it as like it's not magic money. I don't know what you said exactly, but like, it doesn't just kind of appear out of thin air because like, if you're not getting a franking credit, it's probably something's been paid for or collected another way. It kind of reminds me, I don't know if you'd consider this valid, but, it's like if I'm if I'm getting just like a lump sum from someone as opposed to a smaller lump sum with like another voucher or something, like it all might kind of sum up to the same thing in the end. And also like I think to remember, franking credits, as far as I understand it, Dave, you tell me if I'm wrong because I'm not an expert. They are corporate tax rates kind of fed back to you, and corporate tax rate I think is 30%. So it's like what you're really looking at is I don't want to get too complicated in the math, but you're looking at something that's about a third extra of what you got. You know, these aren't going to be double, or like it's not going to double your dividends or anything kind of crazy like that. So if you're kind of sitting around being like, oh, an ETF is 88% franking credit, franked, we call it, and a share's 100%, you're talking about 10% on like a third of a value, and you're really getting into the weeds at this point. And if you're getting into that detail, you better be sure you're paying attention to every other couple of percent that's going on in terms of management. And then it's like, just shut the computer at that point. As Dave said, just maybe, you know, focus on what you actually kind of believe in longer term. I know I haven't ever looked at franking credits more than thought about this US ETF doesn't have franking credits and this Australian ETF does. That has an impact, but I don't think I've ever really thought about franking credits internally, so to speak, like all between ASX things.
Well, and think about the time involved in building a portfolio of just individual companies. That's still a diversified portfolio, and then you've got to build that over time. You're going to be paying a lot of brokerage. You're going to be spending a lot of time managing that portfolio. You're probably going to need 20, 30 holdings for it to be somewhat diversified. So that's a lot of time involved to try and get a bit of extra franking credits. Not that you're necessarily losing out by picking other options. So, yeah.
So I think just like the previous question, there's definitely going to be cases for some people in some circumstances where that is worth really digging into. But if we were to go and grab the average Australian trying to do the average thing, that level of, you know, digging into it is probably not going to use a pun, pay dividends, you know, not, you know what I mean? So, yeah, I think that's a fair summary. Whilst we're on the topic of dividends, there's another question about dividends around how should I think about dividends from US shares versus Australian shares? They seem very different. Well, that's a great question because as a general rule, US companies, US ETFs will pay less dividends than Australian companies and ETFs. If I'm not mistaken, Dave, I think that's mostly just because like with the existence of the franking credit system, Australian companies find it more appealing, right? So it's in a way, it's like the tax system that's set up encourages Australian companies to pay out more, which is why they do. Is that a fair statement?
Yeah, pretty much. I suppose it's pretty much driven by the tax system. So a company in Australia earns money, pays tax, pays you a dividend, and then because they've paid tax, generates franking credits. If they don't pass them on to you, they're effectively useless to the company. So they basically are always going to pass them on to you. And because the generation of franking credits comes when a company pays tax and makes money, there's an incentive there to pass on more of their earnings as dividends because all of their taxed earnings have generated franking credits, right? So because those franking credits aren't really useful to the company, but they are useful to the shareholder because it helps reduce tax on the dividends that get received, versus if that same dividend didn't come with the franking credit, then it makes sense for the company to then pass on more of its earnings because those franking credits aren't very useful to the company, but they are to the shareholder. So you end up having shareholders kind of pushing for more and more dividends. So what tends to happen is US companies will pay out a much lower proportion of their earnings as dividends. And in Australia, they'll pay out a much higher proportion of their earnings as dividends. And so what tends to happen is that US companies instead, they'll pay out maybe something like somewhere between 30 to 50%, I believe, of their earnings as dividends. Whereas in Australia, it's more like 70%, sometimes a bit higher than that in their earnings as dividends. So what tends to happen is the US companies will actually just use that extra money to grow the company, whether it's investing in new technology or new people, or they'll even use some of that money to buy back their own shares, which essentially has the outcome of boosting earnings per share. And in turn, that's partly what leads to the higher capital growth of US shares. So that's a little explainer about why the dividends are different. in the different countries. I hope that answers the question, mate. Does that make sense?
It does. And I mean, I think what helped me was, I think when I was like, wait, how does a company just grow? And someone gave me the example, I think, which was like, if Amazon, went and had a bunch of extra money that they earned and they just went and bought UPS, the US Postal Service, and were like, yep, we're going to add that into our company. If Amazon's worth 1 billion and the USPS or UPS is worth 100 million or 0.1 billion, now Amazon's worth 1.1 billion, so it's like acquisitions are another huge area, I think. And one thing I read about, Dave, I don't know if you know about this, because I was reading it the other day because I was so curious. It's like, so tell me if it's wrong, but it was like when Australian companies pay out dividends, it was like their share price goes down by the dividend amount. Is that something you've read about or know about?
Yeah, every time a company pays a dividend, there's an ex-dividend date, which basically is just this date where shareholders are entitled to the dividend. That's the one that's upcoming, say in the next month or 2 months. And then after that date, you're not entitled to the dividend. So there obviously has to be a cutoff at some point where people are entitled to it and people are not entitled to it. Otherwise, you could just own the share for one day and then get a dividend sell and then do it with every share.
Well, that's what I was Googling. I was like, why don't people do that? Why don't people buy the share and then get the dividend and sell it? And they were like, there's no point, because the company, you get a 2% dividend and your share price goes down by 2%. And I was like, oh, that makes so much more sense now. And I think that actually helped close out my own knowledge gap, because I was like, that is so complete now in terms of, dividends versus just a higher growth. They're just various ways that money moves around. And to the original question about how should I think about dividends from the US shares in Australia, what I would say to that is that because US companies and Australian-based ETFs that I guess invest in a lot of US stuff, US pays less dividends, Australia pays more. One of the biggest things that I've started to do when thinking about US and Australia stuff is just Australia means more dividends now, US means higher share price in the future. Dividends now mean I'm paying more income tax now. US stuff means that it's going to grow more probably, and I'll pay more income tax in the future. So that's been something personally that's been guiding a lot of my decision making in terms of like, do I want to pay lots of little bits of tax now, or do I want to pay big tax later on in life, which is really just down to people's personal circumstances as well. So that's, for me, that's the main thing I think about, but I don't go too deeply otherwise than that at the moment.
All right, the next one's a little bit longer, mate. I've listened to several episodes now and really appreciate your insights. I really like the way you look at things from all sides, and I'm wondering what your thoughts are on ethical investing. Where should we put aside some of our ethical concerns in order to get ahead? And where might some of those concerns be unfounded? It's an interesting topic, mate.
That's an understatement, isn't it? I will be brave and start off. I don't know much about it. I aspire to. I don't currently have the capacity to in terms of my time right now. I hope I can one day. When I look at ETFs and I see an ethical ETF or this ETF or BHPs in that, I just think, man, if there's one thing I've learned every year I get older, it's that like I really don't know much about what's going on. And every time I think I do, I just don't. So I could make some superficial decisions, but then I'm sure if I Googled it, I'd read 6 blogs saying it's not what you expect or it is what you expect. So at a personal level, my thoughts on ethical investing are like, it sounds awesome. I'd love to do it more. I don't have the knowledge or people around me to instill enough confidence in me that there's a clear path to it. Because every time I read about something, there's always some other consideration, or there'll be some ethical fund and then it gets shut down because it turns out it was invested in something that was unethical. And I'm just kind of scared at the moment. But I don't want to misconstrue my kind of like, I don't make too many active decisions on it because I don't know, I don't have the knowledge for it as like a lack of interest in eventually knowing the knowledge. It's just, I feel like I would need to spend so much time reading to get a grip on it all. Which I hope I can one day, but I don't know if that's a bit of a washy answer for you, Dave. I'm not sure if you've spent any time or can alleviate the degree to which things are as chaotic as I think they are, or if they're like less chaotic and more clear cut.
Yeah, it's not the simplest or not the clearest topic to navigate, I'll say. So it does sound awesome. I totally agree with you on that. If it was that simple to just avoid bad companies and then they stop doing bad things or they go away or whatever, that would be pretty cool. But as it applies in the share market, it tends not to work like that. So I suppose the idea of ethical investing is to put your money where you think it's going to do good or at least not do bad. And so behind that idea is the assumption that when we put our money into certain shares, we are doing bad things because the companies are doing bad things. And if we take the money away from those companies, then perhaps they'll stop doing bad things, or we can improve the world somehow, or whatever particular cause you might want to actually help. But it tends not to work that way in practice, because when we invest in certain companies or when we own certain shares, I suppose invest in is kind of the wrong word, because when we buy certain shares, like we buy an index fund, a plain index fund, there's some companies in there that will be doing things that you don't like. But when you own a little part of that company, you aren't actually giving them your money and supporting them in the way that you think. So you can't actually avoid that company and give your money to another company that's good. It doesn't really work like that, because you're owning shares, you're just buying a slice of that share from somebody else who's selling a slice of that share. It doesn't really help the company in any way that you've bought the shares in the company. If you avoid those shares, then somebody else will just buy those shares. And so it sounds like I'm saying, oh, well, everyone else is doing it, so just do it. But I'm not really getting at that. It's a different kind of conversation, because the companies are there and the companies aren't going to go anywhere because people are buying their products, not because people are buying their shares. So people buying shares isn't what keeps a company in business. It's their profits and people buying the products that they're selling. So you can't then kind of gang up together and bully a company to disappear because you don't like what they're doing. It doesn't work like that. Their profits are exactly the same. If you want to have an impact and kind of hurt that company, you need to hurt their profits. So you would do that by trying to get people to stop actually using their products.
Is it fair to say, Dave, if there's an unethical company, buying their products is a great way to keep it alive and maybe make it grow and thrive? But buying the shares doesn't do that. It's simply a way that you benefit from what an unethical company might do, if that makes sense, which is a very different thing, because you benefit from it financially, but you're not like actively, keeping life support on it. It's going to exist whether you bought it or not. You're just now participating in the profits of that unethical company, potentially.
Yeah, you just happen to own some of it. They're not receiving your money. Whereas if you buy their product or resource or whatever it is, they are actually receiving your money in some part.
So it's not so much like buying the shares, you making the world a worse place. It's more just, some people might call that dirty money then, so to speak.
You can call it whatever you like, but that company is going to exist. You avoiding those shares isn't going to do anything. And even if you do it in scale, like by thousands and thousands and thousands of people with huge amounts of money, it just means that you might be able to bully the share price lower. So in that sense, you can hurt the company. I've seen that argument being made. But then what happens is you'll just have more active investors that'll come in and just buy cheaper shares because that company valuation will be too low. Or maybe you'll have a private company that'll buy them out, but the company is still going to exist. It's not going to disappear.
Because if you knock their share price down, some smart people out there smart people who just want to make money, which there will always be people like that, they will go, oh my God, that company's on sale for cheap. Crap, I better buy it up because no one's appreciating it. And you're kind of saying that, well, yeah, if you really want to hurt it, you got to convince people that the company's not worth much. And you do that because they stop selling products, because they stop getting popular. So, if you want to, stop some evil company X, the best thing you can do is not avoid their shares strictly, but actually, somehow convince every single person on the planet to stop buying X's stuff, because that'll be what has the impact. Cool. Makes sense.
I suppose there's another way you can look at it. So if you want to actually invest in, which would be a more accurate word, invest in companies that are working on things that you care about, then you would have to then approach startups, some sort of equity crowdfunding or something like that, where your money is going to literally be injected in a company that is either working on a cause or technology that you care about. That would be a way to use your money to directly impact something that you care about in a very real and very direct way. So another thing that is worth talking about is that the more ethical of a fund, or the more strict of a fund you want to invest in, the higher the fees are, because the fund manager then has to become more stringent in their criteria and the things that they look at when they choose what to put in their portfolio. So it's kind of easy for like a Vanguard or someone to screen out a few fossil fuel companies or something like that and not charge very much extra in fees for that. But then if you want to have a really focused portfolio of like, I don't know, a couple of hundred or 100 instead of, 500 or more companies, you're going to have a fund manager or a team of people sit down and scrutinize every detail of those companies and whether they meet certain ethical standards. And that's going to come with very high fees. And so that's going to come with a pretty high chance of underperformance, I'll say, not only because you've got less companies in your portfolio, but also because you're paying high fees. And so that comes at a very real cost to your wealth and your long-term gains. And so you might say you don't mind that because you're investing in a way that you're happy with and you're hopefully doing good, but you could equally take that money and then the same thing, put it directly into a charity or directly into a cause or something that you care about. And that would again have a more impactful and more direct influence on the outcome you're trying to achieve, because otherwise you're just avoiding different shares, but in a fancier way that's going to be more costly. And personally, I don't think that is the optimal way to go about it. I mean, I don't really have a problem if people want to invest that way. That's totally fine. It's up to you. But I don't really buy the marketing, and I think there is other options that other things that you can do with your money instead, which will have a better impact and achieve the outcome you want. So I'll just say that there's a few issues and it doesn't really work how we would hope it would work, unfortunately.
Makes sense. I think the only last thing I'd probably add on is, ethical is a broad term too. And, sometimes we break ethical up into like environmental and social as two, and you can go further than that. But there's probably a bunch of companies out there, I imagine, that are very bad for the environment. But they probably got social programs and scholarships and like all this other stuff set up that's like good for society in the non-environmental sense, and vice versa. And this is, I guess, where it does get a little complicated, is if you are quite engaged with it, you kind of do need to go one level deeper and ask, like, what does ethical mean to you? Because obviously there's no intrinsic definition. There's just widely accepted, agreed upon definitions that, like chopping down rainforests is probably bad. That's a good example. And actually ask yourself, like, am I more socially ethically focused or environmentally ethically focused? Because you're going to get different companies, ETFs, will land differently on that, so just go that one step deeper if it is something you're trying to tackle. Again, I want to tackle it in the future. I know I will get around to it. And I take a lot of comfort knowing that, the benefit of these liquid public market ETFs is that I can always just wake up one day and sell them if I really don't want to, and buy something that I think is better for the world if I happen to learn more about it. Cool. Let's move on to our last question for tonight, Dave. Bit of a big one, but I like it. So this person is talking about a theoretical where they say, if I have $600,000 in super and assets, I can get the full pension from the government when they reach pension age. So the government will, pay them their fortnightly amount to help fund their life. They can also generate their dividend income from their super investments. And the question is, why should I work harder than that? Why should I go from 600K to $1 million or to $1.5 million or $2 million to get more dividends just to get less pension? Because like a lot of government support, and our young people know this with like Centrelink and youth allowance and things, you get to a point where the government's like, you're kind of rich enough, you don't need our help. So there is some benefit to flirting on that line of like, what's the richest I can be until the government says, you're too rich, we're going to take stuff away from you. And yeah, essentially it's like, how do you thread that line where you have that scenario where it's like you work super hard and you be even wealthier, or you just kind of coast along and you kind of hit in the middle? That wasn't the exact way the question was phrased. I kind of elaborated on some things just for transparency, but that's, I think, our interpretation of what's being asked. I mean, what's your plan, Dave? Are you going to do keep your assets down and enjoy the pension, or are you going to go for gold and try and get that bit extra?
I think I probably won't be eligible for the pension unless I start spending extremely aggressively with my wealth now and any income I earn in the future. But I don't know, I'm not really interested in that. So I guess I'll end up in the too rich for the pension camp, which is not a bad problem to have, I suppose. What about you, mate? You planning on a part pension or not?
Oh, it's tricky. I mean, it reminds me of that age-old question. It's like, do you want to work, 1 hour a week for $1 or 3 hours a week for $2. You know, that's kind of like
I haven't heard that before.
It's not an expression. It's stupid. I just said that then. But, you know, it's like the idea of it. It's like,
Okay, yeah.
you know, one is maximizing dollar per effort and the other one's maximizing outright dollar, right? I'm sure it's a fairly universal idea. I mean, personally, I don't want to eat my words later on in life. In like 30 years, this podcast comes out, but I would love to not be on the pension just because I generally have an anxiety that we have a lot of people on the pension, and every year I hear more doom and gloom things. So I would love to have the privilege and the, you know, good fortune and hard work to be able to like not continue being even more of a burden than I need to be. You know, if I'm healthy and I'm capable and I cannot contribute, that just means in theory, very theoretically, someone else can have some benefit. And I won't go into that because obviously someone's like, well, don't use Medicare then and stuff. And yeah, you can go like 6 feet under with it, but it's like,
because that also brings in its own sort of ethical conversation, doesn't it?
Exactly. So I don't want to sit here and be like, oh, you know, me try so hard, because it's very complicated. But at the age of 30, I look at that and think, oh, it'd be cool to be independent and not, you know, add an unnecessary burden on. But again, we'll see what happens there. I think that personally, I would prefer to aim higher than that for sure. Where I think all this stuff gets complicated without turning into a full-blown pension conversation is you do have those people out there that might have a few $1 million and they say, you know what, I'm just going to go buy a really expensive home, really expensive, and I'll just like cut my actual assets down and then I'll do the whole pensiony thing. They sell all their investment properties, and that's a pretty common thing I see. So it's hard to say because like right now I don't want to, but maybe I'll get old and be like, oh, you know what? I don't need that much independent dividends. I don't mind relying on the government too much. And I don't know. It kind of just varies. But I guess that gets to the point of the question, the point of the answer, which is, it's just different for different people. Like some people really value that independence from government, or some people really value just being really wealthy. And some other people value not pushing themselves too hard. You know, like they wake up when they're 30 or 40 and think, I'm tired. I've been working 2 jobs for 10 years. I don't want to do this. I don't mind being on the pension and just kind of being middle class when I retire. So the tail end of that question, what's the best strategy? It's the worst answer Dave and I give because it can always feel like a cop-out, but it's like, depends on your goals and objectives, of course. It's
the truest answer though, isn't it? Because you nailed it. It's going to be different for everyone. So it's so hard to say. I suppose I would try and frame it like it really depends. The pension and some super, if you add those two together, you will be limited in what you're able to afford in terms of lifestyles. So if you have more expensive tastes, that strategy probably isn't going to work. So that's something to consider. If you're someone who wants more luxury or more comfort in retirement with lots of holidays and this and that, that's probably not going to be enough. So you're probably going to need to be sort of independently wealthy to be able to cover all of those expenses. In addition to that, I would say that the superannuation system wasn't really running long enough for the current retirees to then fully benefit from it and live off their super entirely. But people that are at a younger age now, I would say that it probably will be enough. Like people in their 30s now that are working, if they plan to keep working for another 30 years, I would say that when you accumulate all of those super payments and that compounded investment returns, that it will eventually be enough to live off where you won't really need a pension. And that's the reason why it was designed, to reduce the burden on the pension and on government cash flows. That's my understanding of it anyway.
Yeah, and I guess that's a consideration because I didn't think about that, Dave, but you're right. I guess if you were born before 1975, which is, you know, my parents, you weren't putting money into super when you were 18. So, you know, they have less there. But I love that point too, because it makes me think that the government, which can be pretty smart sometimes, once it cracks on to, you know, how much money people have in super, those numbers might change. You know, if the nature of the population changes and their wealth changes, rest assured the government has a very high chance of tweaking those numbers too. So it's very hard to kind of reverse engineer like a finish point and how hard you want to work, because you think, oh, you know,